1. And welcome everybody to another Smart Money Circle show. I'm Adam Sarhan. With me today is Daryn Dodson, who's managing partner at Illumen Capital with around 250 million in assets under management. Daryn, thank you so much for coming on the show.
Oh, it's great to be here.
So I always like to begin. Can you tell us your story and how you got to where you are today, please?
Sure. I grew up in Washington, D.C., started looking at and understanding the asset management business after graduating from Duke University and focusing on anti-predatory lending legislation, which I worked with a group of attorneys to pass legislation in 18 states to protect low-income homeowners from predatory loans.
Thank you for that.
After that, I had the opportunity during that time to look at research as a power for creating change. And the research there showed that loans were underwritten above risk to Black and Latino families in particular, which was, created a lot of people stuck in loans for reasons that hurt them as overall borrowers over time, which was bad for banks, but also hurt them in terms of, no one should pay more for a loan because of the race or color of their skin. So using those insights, ended up going to Stanford Business School and then focusing on underwriting for companies that create positive impact in the world. And that's been my focus for the last 15 years of my career. I did 8 years at the Calvert Funds, where I focused on investing in transformative, environmentally focused companies, as well as health tech companies, before starting my own firm, Illumen Capital, which I'm excited to share more about today.
Perfect segue. By the way, fantastic cause. I love that there's a purpose behind the mission there. And that's really, really fantastic. So next is a perfect segue to my next question. Please tell us about your investment strategy.
At Illumen Capital, we're fund of funds. We're private equity, venture, and growth fund of funds. We focus on investing in the leading impact funds in the world and working with them to apply rigorous evidence-based strategies to address biases that prevent our managers from seeing the all too often underestimated and overlooked entrepreneurs, talent within their hiring processes, and then also within their board construction and selection processes.
Love that. So you're a fund of funds, meaning you're looking at other strategies. I guess it's a good segue again to my next question. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
Well, one of the things that we do is that we look at investing in an area where there's latent value in our investment strategy. So when we look at the asset management business, about $82 trillion under management, 1.4% of it is managed by women and people of color. So one might naturally think that there would be an opportunity in investing in, 50% of the universe of possible funds would be women-led. So we might look to women-led firms as a potential for outperformance, and women and people of color-led firms. In fact, our own research with Stanford University, where we systematically tested 180 asset allocators, and looked at their ability to select high-performing Black managers versus high-performing white managers, controlling for a number of variables. And we found that systematically asset allocators would leave money on the table before investing in high-performing Black-led funds, which means that there's a tremendous opportunity for those that can see the opportunity, which is the way we spend a lot of time partnering with our downstream funds in order to unlock the verticals that we invest into and their ability to see these. We liken it to driving a car. Mm-hmm. And if you're driving a car and you've ever had your parking brake on, something's going slower and you're not sure quite what for a while, and taking the blinders off and seeing opportunity within communities that might be different than fund managers meet through their networks or through familiarity might in many cases, given our thesis, sort of yield economic opportunities that it might not have seen.
I love it. I love that. So I guess next question for you let me ask you about the risk again. So you're saying that there's basically a layer of the market of portfolio managers that are allocators are underinvested in or underallocated towards, and that's strictly based on their race. So are there other indicators that you use as far as finding these undervalued money managers and allocating to them? Do you look at strategy? Do you look at beta? Do you look at Sharpe ratio? Anything along those lines? Or is it just a race component and gender?
Yeah, in the private markets, we also have a sector-based strategy. We have 4 sectors that we invest into: transformative environmental technologies. We look at health-enabled technologies, as well as educational technologies, and financial tech. So when we look at these different areas, each of them have their own respective biases within the strategies and the firms and the companies that the respective funds we invest into commit to. And we're able to add, our unique thinking about overcoming biases to each of these different platforms. For example, within EdTech, we see that underwriting algorithms, machine learning, et cetera, can apply in the biases of a teacher so that education isn't delivered in an equitable way. So if we're interrupting those biases, it increases the education for all students in the classroom and helps the firms deliver on important aspects that are important to the education system. Furthermore, we see in a period of high volatility like we're in, high inflation, high interest rates, et cetera, that biases increase from our social psychologist friends. In fact, we published a paper with some of the leading social psychologists in the world. And what we learn is that in these periods of time when people are often making rash decisions, slowing down and addressing biases becomes even more important. So I think that one of the ways that we mitigate risk whether it's Daniel Kahneman talking about his Nobel Prize winning research, is under these pressure-oriented conditions where there's lots of emotional energy in the markets, we're able to help our managers slow down and address some of these biases that might occur.
Okay, so that makes perfect. So it clicked in my head as you were speaking. Thank you for that. So basically your alpha, your strategy, your edge is being able to find cognitive biases that exists in all our minds and then help, I guess, narrow it down over there to help this discover or find these undervalued assets that most people would miss because it's a blind spot for them. Is that a good way of wording it?
That's it. I mean, the assumption, I often say, like, cognitive biases, as we know from Charlie Munger and Daniel Kahneman, are a very broad number of hundreds of different biases that might show up. Yeah. But we take kind of a broad view that if 1.4% of $82 trillion in assets are managed by women and people of color, one of the biggest biases that the market might have, especially after our research that shows the higher people perform, the more bias they face if they're Black. Yeah. And one of the biggest biases that we might see facing women and people of color in the market is the inaccurate assessment of their ability to outperform relative to the analysis that's currently being done. So while many cognitive biases may yield an opportunity in markets, this one is so imbalanced relative to what we'd expect by random chance that we think that there is a massive value that underlies people's ability to properly underwrite this group. Just like I saw, initially in the banking system where people were being underwritten significantly above risk because they were Black or Latino.
Yeah, no, I love that. So I wrote a book about psychological investing. It's psychological analysis, and it was #1 on Amazon for 2 months every day. And in it, I have yeah. So you're speaking my language, so to speak. I have a whole section on cognitive biases, and I'm very, very big on the whole idea of the book is to teach you how to make rational, not emotional decisions, especially with your money. So what you're saying here is it's spot on. Like I've got my mind going in a gazillion different directions here. I love that you were able to take that realization you have, and then create a whole entire business around it. And being a fund to fund manager, you can help, I guess, find those blind spots that other people would miss. So that to me is fascinating and brilliant, by the way. So hats off to you. I mean, really, really, really great job.
Thank you.
So, okay. Well, let me also give the audience something. There's something called a personal blind spot bias, one of these cognitive biases. So if you ask 100 newlywed, in case the audience isn't following, here's how to explain it. Ask 100 newlyweds the night of their wedding, raise your hand if you think you can get divorced. Almost no hands are going to go up. Yet statistically, we know half of them are getting divorced. That's called the personal blind spot bias. And that's a blind spot that people just don't see if you're in it. But if you're out of it, you can clearly see it. And that's what, I guess, what you're doing over here in an investment standpoint.
Mm-hmm.
So, yeah, no, I love that. Okay, timeless lessons. What are some timeless lessons you've learned along the way that you'd like to share with the audience, please?
Well, one is the power of James Baldwin's contributions to our work. And James Baldwin often talks about people and the way that they think, the way that they act, and the difference between and the space between those two. And he says many people think that they would like to do the right thing, or underwrite with these types of tools.
Yep.
But when they try to move into action, there's a danger of, like you just mentioned in your example, sort of understanding how their identity might be challenged in the process of acting. So in some ways, removing some of the emotion from the underwriting process sort of helps us to get there. I think in studying something like both of us have been working on, and something that's unseen, bias by definition, it's
Right.
going to be a little bit harder to explain to people something that they don't naturally see.
Right.
But I think that the consistent frameworks for questions that we ask, those that we're evaluating, although it seems quite simple as an analytical framework, we often see it change drastically when women are presenting in large numbers of downside questions that are asked. Isn't the risk of this business greater than other businesses? Are you afraid you'll run out of money or not hit your milestones? Versus men, who are often asked, how hard can you hit the ball over the fence, or how big could this opportunity be? These heuristics creep back into the process of investing. And the field that we're in within venture capital, although we found similar findings within public equities as well as fixed income, when we look at private equity, venture, and growth areas where we invest into, there's often massive value creation and upside that could be lost if we're missing some of these biases in a major way. In other words, being second or third in a category isn't always a desirable position. So really choosing the number one entrepreneur in a particular field, it can be very, very valuable. So investing heavily in the underwriting process to partner with our managers is something that we focus on for that reason as well.
Oh, I love that. So let's talk about timeless mistakes. What are some timeless mistakes you've learned, you've made, and or how do you avoid them that you want to share?
So I think one of the timeless mistakes that I've seen made quite often is the creation of something new. Let's call it the field of impact investing, or ESG, without one of the critical success factors in producing alpha, which is namely the inclusion of women and people of color. And particularly because of this finding that shows that bias increases when performance increases, which is sort of the hallmark of our paper. So weeding out top performing managers because of their race, timeless mistake that I think a lot of portfolios could benefit from intentionally looking for managers that they might inadvertently, through bias, weed out. Also, I think it's an important dimension of fiduciary duty. So it turns out that this timeless mistake is also important for that reason, because if we're trying to be great fiduciaries and we notice that a dimension of outperformance is missing from our pipeline, i.e. women and people of color-led funds,
Right.
that in some cases have more often than not produced at or above results, then we should be looking, carefully through the portfolio for these opportunities.
I love that. That's really, really smart. So you're able to almost shed light, if you will, on that blind spot and then extract alpha from there, if I understand your process.
Yeah, that's right. And it's sort of consistent with modern portfolio theory. We want to start with a set of the investable universe.
Yeah.
And what we found is that in evaluating pension funds, sovereign wealth funds, university endowments, family office asset allocators, that they are not looking for inadvertently sort of some of these alpha producing managers, which in some cases are women and people of color led funds. I know the National Association of Investment Companies, for example, has done research over the last 40 years showing at or equal performance despite this, kind of lack of additional asset allocation to managers of color and women-led funds. So when we combine, the thinking there, we ask, well, why aren't asset flows following performance?
Mm-hmm.
And one of the things that we think and hypothesize on, and there seems to be some, important additional work to be done, is that bias is one of those things that can make the mind think differently about allocating capital to outperforming funds.
Right. Yeah, you're chasing returns, and then that makes perfect sense. Okay, next question. What's the best piece of advice you'd like to share with the audience or your 20-year-old self?
Let's see. I think that one of the exciting pieces of advice that someone gave me, and this is a consistent, I found it to be somewhat consistent, but my venture capital teacher at Stanford Business School was Andy Ryclef, one of the founders of Benchmark. And, he was one of the people that told me, big ideas come from two major conditions. And many listeners may be familiar with this. One is that they're non-consensus, and the second is that they're right. So in other words, if we went around to a number of people and we asked them if this idea was a good idea, a lot of the people would say, I don't know, or be confused by the idea. And the second condition is that, there's economic value associated with delivering on the other side of that idea. Now, I think the idea of bias facing women in color in asset management, when I go around and talk to leaders of financial institutions, a lot of them seem puzzled at first, but when they look around their offices and their industry and they see 98% of one race and one gender in the industry, they then begin to kind of examine how bias might be showing up. And then the second piece is the associated latent economic value with fixing that problem or addressing these biases. And, that's the essence of Illumen Capital's message and thesis. So trying to follow Andy's advice there and sort of find an area where there's untapped value that many people may not understand or have attention focused on for one reason or another, and deliver that value to, of course, our investors, and create a movement of others that see this value and can build organizations to address it.
It reminds me of the story with Henry Ford. If he was going to ask his customers what they wanted, they would have said a faster horse and buggy, but instead he invented a car. So yeah, that makes perfect sense. So, okay, beautiful. Well, Daryn, this has been absolutely fantastic. Thank you so much for coming on the show. What is the best way for people to get in touch with you? Is it a website, or how would you like people to reach out?
Yeah, I think just go to our website and you can learn more about our work at www.illumencapital.com.
Beautiful. Well, Daryn, thanks so much, and hopefully we'll see you again soon.
All right. Really appreciate it. Thanks a lot, Adam.